Go. Morning, everyone. We're just going to take a couple of minutes and for any late sign-ins to load up their computers, but welcome. Okay. Thanks everyone and welcome today. It's great you could join us for this webinar to introduce and commence our short course on organisational carbon accounting for local governments. My name is Luke Wilkinson and I'm from Sustainability Victoria, an agency of the Victorian State Government. We're charged with supporting Victorians to use resources sustainably and to take practical action on climate change. We're really pleased to support this first webinar today, introducing the carbon accounting course. I'd like to introduce Marissa Sanchez and Charlie Nags from Point Advisory. Before I hand over to them to run you through the webinar, a bit of housekeeping. The format for today is that Marissa and Charlie will run through this Foundations webinar that you'll be able to hear and view on your screen. You will be able to post questions and comments during the presentation by Skyping in the Skype Q&A section. That's either going to be on the bottom of your screen or along the side of your screen, depending on your configuration. Those questions as they pop up will be addressed and during the presentation. And the webinar today is also going to be recorded and a link will be made available on the Open Learning platform. Great. So why this course and why are we here? So Sustainability Victoria has been working with a number of Victorian councils to update their corporate emissions profiles and work with them to develop a reduction plan. We're going to continue to work with those councils as they move through doing energy efficiency and renewable energy, identifying those opportunities to work on energy efficiency and renewable opportunities in their buildings and facilities. What we want to see is that once a Victorian council knows where it stands with its carbon footprint and knows what it wants to do to reduce it, this carbon accounting course will assist those councils with their ongoing measurement and verification during that journey ahead. This course is just one component of the approach that Sustainability Victoria has developed to work with local governments together to take action on climate change and to reduce our carbon footprint and plan to act on the opportunities that present in this transition to a low carbon future. We really recognise that Victorian local governments have been doing great work in leading the progress internally with their emissions reductions, but also with their local communities and across the local government sector. Really want to acknowledge that. We see now that 46 councils have signed up to our Take Two pledge to take action on climate change, and that represents more than 77% of Victoria's population. Upskilling and building capacity in the corporate carbon accounting, we hope, will assist Victorian councils to plan strategically for further internal emissions reductions actions and investment. So over to you, Charlie and Marissa.
Thanks, Luke, for the intro. So welcome everyone and thanks for registering for our course on organizational carbon accounting for local governments. So I'm just going to start by running through the course and the elements that we are using to deliver on this course. So this first slide, as you might be aware of, we are using a blended approach. So we have three avenues through which we are going to deliver this course. The first avenue is the Open Learning online platform. So that platform is live from last week. So for those of you who haven't yet enrolled, please do so. You should have got an invite from Open Learning to enroll in the platform. So you need to create your own account, and then you need to enroll in the course. If you have any issues with that, please send through an email, and we'll try and help you get that sorted. Within the online platform, there are two elements. There are three elements in the platform. One thing is the learner guide, which is going to be the document holding most of the theory that we're going to give through this course. It also has some additional reading and additional videos that you can check if you want to know a bit more about specific elements of the modules. And after each of those modules, there's an online quiz that needs to be completed successfully in order for you to be able to go to the next module within the online platform. So please enroll, and also once you're in the platform, please be aware that the quizzes have due dates, so you need to complete the quizzes before the due date to be able to complete the course successfully. Then we have the second element that we have in the course is the live webinars. Today is the first live webinar. We're going to have 3 of these webinars. The intention is that you guys go into the Open Learning platform before the webinar, read through the theory, and come to the webinar where we will walk through the theory, but it's an opportunity for you all to send through questions and open the discussion. And if there's anything that wasn't clear enough in the learner guide, this is your chance to ask questions and debate and get on with the conversation. So then the last element is the face-to-face sessions. We will have 2 of those, and in those ones we are going to try and be very practical. We're going to try to apply what we learned through the live webinars and the online platform, and to actually help you guys get out of the course with some valuable work done, basically.
And just in relation to those face-to-face sessions, the intention is very much, certainly for the first session, that you will leave that course with an inventory or a very good start on an inventory for your organisation. So just to, I guess, reiterate Marissa's point that we are trying to keep it really practical and actually have you guys leave the course with something that you can use to kind of take carbon mitigation forward within your organisations.
Yep. Can you, for those of you, if you're having trouble looking at the slide deck, try and refresh the browser, and hopefully that means you can see the webinar. Otherwise, just let us know through the Q&A if you're having any issues, and we'll try and solve them for you. Just on the next slide, this is a bit about the structure of the course. So this is the first time we talk to you all since last week when the course officially started. So just for your benefit, this course is divided into 2 units. Each of them has 3 modules. So Unit 1 looks at developing an organizational carbon inventory. It has 3 modules. The first one is foundations, which is today what we're going to talk about today. The second module is about accounting boundaries and knowing what needs to be scoped in your carbon inventory and what needs to be left out. And the third one is about actually developing the carbon inventory and calculating your emissions. So as you can see there's a few icons, next to the boxes, which say basically Module 1 is delivered through the online platform and a live webinar today. Module 2 is delivered through the online platform and another live webinar, which is coming up on Friday at 10 a.m. And then we will have 4 weeks in between Module 2 and Module 3 for you guys to go away, and once you've defined your boundaries, which hopefully it will be clear for you after Module 2, you go away and define your boundaries. And for those of you who have the boundaries already defined, maybe go and revisit them, and then gather the data that you need to populate your carbon inventory, to come to Module 3, which will be delivered through a face-to-face session with all the data that you can gather to make sure, as Charlie said, that we can use that data during the face-to-face session to populate your carbon inventory so you can get out of the session, hopefully with a very well-developed or finalized carbon inventory for your council. And then once we do that, then we're going to Unit 2, which is more around reporting and planning. So it's basically what we do with the carbon inventory once we've done the calculations. So the first module will focus on how you can document the results of your carbon inventory. Module 2 will be around setting emissions reduction targets. Those two modules will be delivered through the Open Learning platform and a combined webinar. So there will be one webinar for those two modules. And then module 3 will look into how basically you can use your carbon inventory to inform your strategic planning and your investment decisions, which is the end goal of Sustainability Victoria's Stream 4. So that will be delivered through a shorter face-to-face session of about 3 hours, but that's it's a bit far away now. But yes, so that's the structure of the course. That's how it's all gonna be running from now. If there are any questions on the course, just put them through the Q&A section, and we'll make sure we solve any queries you might have on the course itself.
So we're just getting a couple of comments through that it seems that one or two people might be having some minor technical issues. If that's you, just try refreshing your browser, try switching it off and switching it back on again, and that may do the trick. It seems to have worked for one other person. So before we get started on the course material, we thought it would just be interesting for everyone to understand who is participating in the course. So as part of the sign-in process to our open learning platform, there are a couple of survey questions there that we ask people, and I think it's interesting just to get an understanding of the level of experience that people have in relation to carbon accounting before we get started. So for the course, we have currently 40 people who have enrolled via the open learning platform, and as I say, we asked a couple of basic survey questions as part of that, and we had 33 responses to those survey questions. And the types of organisations that we've had enrol are mainly councils, as you would expect. But just for people's information, we also have a couple of SV staff enrolled, and we also have at least one water authority involved. So the state government in Victoria owns water authorities, and those organisations have actually been quite progressive in the carbon mitigation space, and so we've had at least one water authority also enrolled to get a better understanding of carbon accounting. So the first question that we asked people was, has your council or your organisation prepared a greenhouse gas inventory before? And you can see from the slide here, we had 33 responses, 20 people said yes, and 13 people said no. So for a lot of you, we know that your organisation already has a carbon inventory, and maybe you're here to try to improve on that inventory or update that inventory, or maybe that inventory was prepared by someone else before your time, and now you're looking to develop skills to be able to take that inventory forward. But there are a few people whose organisations, about almost more than a third of people whose organisations have not prepared a carbon inventory before. So that starts to speak to a little bit of a range of levels of experience of people within the course, which is then further emphasised perhaps by this next slide. So the question here, pardon me, the question was, what is your current level of confidence in applying carbon accounting principles and practices? And again, we had 33 responses, and we've got quite a few people there who don't have very much confidence at all in their carbon accounting skills. So that's great, because that's why we're all here, is to develop those skills. But then there are also quite a few people that have ranked themselves as 7 or an 8 in terms of their confidence of applying carbon accounting principles. So quite experienced in the space. So I guess it's important for all of us to understand that there's a range of levels of experience of people attending the course, and I guess the challenge for us is to make sure that we bring everyone up to the same level, and that we for people who don't have as much experience, we make sure that we're bringing them up to the required level of experience while still remaining interesting and engaging for people who may have done a lot of this stuff before. Marissa, so that's
promise things you cannot deliver on.
That's the challenge for you.
Thanks, Charlie.
Is it worth just also mentioning, we had another comment here, someone's video stream seems to have spontaneously paused. And if you press play, apparently it starts up again. It seems that, it seems that just by pressing play, you can maybe keep it rolling. So apologies if you are having technical issues, but if your stream is pausing spontaneously, just try pressing play.
Cool. So basically, the objective of this first module, which is called Foundations, is basically what Charlie was just mentioning, which is bring people up to speed, run through a bit of the basics of carbon accounting, what sort of methods and standards are out there, so everybody understands just the basic concepts before we actually get into the complexities of carbon accounting for local governments. So the objectives of this first module is basically understand the business case for carbon accounting, so what's in it for you, why you should do it if you are not doing it already. Then understand what are the carbon accounting standards and methods available to you. And then we will also talk about which ones are the ones that are most used in Australia and generally used by local governments. And the third point there is basically just, how can you use, what emissions factors, what are they basically, and how you can use them, where you can find them, and how you can apply them to your carbon inventory.
Okay, so first up, I just want to make an acknowledgement that I know from bitter experience that webinars can be quite dry to attend. So our intention today is to try to make this as interesting and engaging for everyone on the webinar as possible. And we think that a good way of doing that is for you guys to ask questions and engage with us. So as if we were in a kind of workshop format. So Luke, I think, mentioned before that we have the chat functionality. This little computer here is monitoring all of that. So if you guys send through messages, we'll get them straight away. And we're really keen to hear any questions or points of clarification that you might have along the way. So please, no matter how trivial or seemingly silly a question or a comment you might be, send them through and we'll address them as we go through to try to turn this into a bit of a two-way thing. And I've told Marissa that in order to try to keep that conversational aspect of it going, we might even pose questions to each other along the way just to stimulate a dialogue. So at the end of the session, we did want to come back. We've got a bit of time set aside for general Q&A, and the sorts of questions, just so that you guys know the sorts of questions we might want to ask you at the end of the session they're on the slide here today. Questions like why are you developing a carbon inventory? What do you see as being the benefits of doing it? Are there any specific standards or frameworks that you need to comply with in your carbon accounting and reporting, either put on you by council itself or by some other organisation? And then how are you using your carbon inventory if you have one, or if you don't have one, how are you planning to use your carbon inventory? Is it to develop targets? Is it to inform strategic planning? Is it to identify emissions reduction opportunities? Is it some other thing? So we'll come back to those questions at the end. So if you start sort of pondering those as we go through the course material, that'd be great, and we'll get your thoughts on those at the end of the session. Before we get started, last thing before we get started, this has been quite a preamble. We just wanted to clarify that local governments, we know, are typically interested in two different types of carbon inventories. There's an organisational inventory and there's a community scale inventory. So in simple terms, the organisational emissions inventory is those emissions that occur as a result of council's activities, while the community inventory is emissions that occur within the geographically defined council boundary. So as a kind of example of that, we have on the screen here a map, obviously, of the City of Melbourne. The red line is the geographic boundary of the City of Melbourne. So a community inventory would take account of all emissions that occur within that red line. So whether that's from residential energy related emissions, all of the transport that occurs within that boundary, all of the waste that's generated within that boundary from households and businesses and the like, as well as any council activities that occur within that boundary. The organisational boundary, on the other hand, would just account for the emissions associated with the activities that are undertaken by council. So that would be things like energy consumption at town hall. It would be any aquatic sports and aquatic centres that are owned or operated by council. It would be, in the case of the City of Melbourne, the Queen Victoria Markets, which are owned by council. It would not include household and business emissions. It's just the emissions associated with council activities. And to be perfectly clear, this course only focuses on organisational inventories. We're not looking at community inventories as part of this course. So bear that in mind as we go through the course. Okay, so on with this first foundations module of the course. And at the outset, we think it's important to get a bit of an understanding of the climate change, the state of climate change policy today. So at the international level, the main governing framework for climate change mitigation is the Paris Agreement, which I'm sure most of you have heard of. Pardon me. And the Paris Agreement, at its core, basically the entire world agreed at Paris to keep average temperature increases to well below 2 degrees on pre-industrial levels, and to aspire to keep temperatures below 1.5 degrees. So that's what the world basically signed up to at Paris. And what the scientists tell us that means, so certainly in order to achieve 1.5 degree temperature increases, we need to achieve net zero emissions as a planet by 2050, or probably much earlier for the 1.5 degree target. So Australia obviously signed on to Paris, and in fact all parties to the Paris Agreement in the lead up to Paris were asked to develop nationally determined contributions, or NDCs. And these NDCs are basically pledges that those countries said they could achieve by 2030. So they're 2030 pledges for emissions reductions. And Australia's nationally determined contribution was to reduce greenhouse gas emissions by 26 to 28% on 2005 levels by 2030. And then it's important also to note that all of those NDCs, as part of the text of the Paris Agreement, are required to be reviewed between now and 2030, and the strong suggestion within the text is that they will need to be ratcheted up in the period to 2030. So they're not static targets. They could be increased over time. So then, partly in response to Paris, but certainly in response to that goal of, or that need to limit temperature increases to 2 degrees, Victoria signed into action the Climate Change Act in 2017, last year. And the crux of this act is really a legislated net zero emissions target by 2050 for the entire state of Victoria. And then there's also an interim target of 15 to 20% below 2005 levels by 2020. So that's, as far as I'm aware, the first legislated net zero emissions target in Australia, led by the Victorian government. And there's a few different mechanisms that they are putting forward to achieve that. And the main mechanism is really around pledging. So we talked about pledging a bit today, but basically under the Victorian Climate Change Act 2017, there will be, between 2020 and 2050, pledges will need to be made for the whole of government on the one hand, and also for key emitting sectors on the other hand. 5 yearly pledges will need to be made in terms of the emissions reductions that those sectors and the whole of government can achieve over that period, so that the government can track progress towards net zero emissions by 2050. Now that Climate Change Act, in terms of the local context, the Climate Change Act does allow for local governments to produce pledges to reduce emissions that they have caused or otherwise influenced, should they choose to. So that's not a requirement of the Climate Change Act at the moment, but there is a mechanism there for local governments to pledge into the Climate Change Act, into Victoria's net zero emissions by 2050 target, should they choose to. So that's something that you all may wish to consider as part of your carbon accounting. And then we also know that there's other programs in play at the local government level too, like C40, like the Global Covenant Mayors, and these organisations are setting a pretty strident agenda in terms of emissions reductions, but they're also providing tools and research to allow local governments to drive climate mitigation actions within their own areas. So the point, I guess the key messages there. Firstly, that there's a lot going on in climate change mitigation at the moment at all levels, internationally, at the Commonwealth level within Australia, at the state level, and also at the local level. That local governments have a really significant role to play, both in terms of climate change mitigation and also adaptation. But thirdly, and crucially for this course, that carbon accounting underpins every one of those activities. So we can't set net zero emissions targets, we can't set interim targets, we can't make pledges, we can't do any of those things if we don't have robust carbon accounting frameworks in place. So hopefully on the back of this course, you'll have the skills to be able to develop those carbon accounts within your own organisations and help drive this agenda forward.
Do you want to mention as well quickly about what's happening at this Conference of Parties this year and the Paris Rulebook and how that's going to fit into?
Making it tricky for me, Russ. Look, I think the main, so there is, that every year there is a Conference of Parties under the UN FCCC. This year, in my mind, the things that they're trying to sort out this year are around some of these the technical aspects of carbon accounting and driving that agenda forward, but also around carbon markets and the use of carbon credits to be able to help countries meet their pledges. So firstly, the question of whether you can use carbon credits, and secondly, if so, which ones and how many and where do they need to come from and what sort of certifications do they need to have. So for me, that's going to be the really interesting development over the next 12 months or so, is around those rules for carbon markets, international carbon markets, linked carbon markets, and the role that carbon credits and carbon markets can play in helping to drive mitigation under the Paris Agreement.
And making sure that everybody is using the same framework to account for emissions. So we are all counting emissions the same way.
Yeah.
And I think that's going to be important. There might be some ramifications of that process of developing the rules flowing into how Australia does carbon accounting as well.
And we've just had a comment there from Tony from East Gippsland Water reminding us that the water sector pledges were actually submitted last year, and they cover the period 1 July 2018 through to 1 July 2025. And so in some respects, the water sector has actually been the leader in Victoria in terms of carbon accounting and mitigation. So all of those water authorities within Victoria, there's about 30 of them, I think, were required to put in to pledge the emissions reductions that they think they'll be able to achieve over the period to 2025, using things like renewable energy, using energy efficiency, doing things like capturing biogas from wastewater treatment. So that we can actually learn a lot from the water sector in this regard.
Great.
Okay, so valid question to ask would be, why would a local government decide to develop a carbon inventory? I guess you guys are all attending this course, so hopefully you're reasonably convinced as to the merits of developing a carbon inventory already. But some of the reasons that you may not have thought of are on this slide here. So there's two broad categories that we can use here. There's, on the one hand, you would develop a carbon inventory to manage risks, and on the other hand, you would develop one to take advantage of opportunities. So in terms of risks, there are the first one we've got there is around regulatory requirements. So at the moment, there's not a great deal of regulatory requirement in Australia in terms of climate change. At the federal level, we have the National Greenhouse and Energy Reporting Scheme, which has been kicking around for 10 years now, which is just a reporting scheme. It's not it doesn't require any action to be taken per se. But that scheme doesn't hit local governments, it only hits corporations. But many of you may remember that it wasn't so long ago that we had a carbon price in Australia. So 2012, 13, 14, we had a carbon price in Australia, and that actually imposed regulatory requirements on several local governments. I think it was entirely around landfill gas emissions. I can't think of any other sources that may have been captured there, but for those local governments that own and operate landfills, those landfills would have been captured by the carbon price. So those councils were required to measure the emissions from those landfills, and then they were required to purchase carbon credits to neutralise, essentially, to the value of the emissions from those landfills. So whilst the carbon price is now gone, that's just an example of where a regulatory requirement could impose carbon accounting requirements on local governments, and you know, as far away as it may seem to many of us at the moment, there is still the consensus generally still seems to be that a carbon price is the most efficient way of dealing with climate change, and so it's not beyond the realms of possibility to imagine that that a carbon price may re-emerge at some point in the future. Which brings us to the future reporting requirements. So the ENGA scheme conceivably could be expanded to, that's the National Greenhouse and Energy Reporting Scheme, could be expanded to local governments at some point. Or some of you may be aware that the state government departments are currently required to report their greenhouse gas emissions under the what's called FRD 24C, Financial Reporting and Disclosure, I think it is, 24C. It's a part of the Department of Treasury and Finance, and all government departments report their office-based greenhouse gas emissions to Treasury and Finance on an annual basis. Now, again, it's not beyond the realms of possibility to imagine that something similar may be imposed on local governments to have to report their emissions at some point. Liability risks is another one. So while, again, there's not a huge amount happening in this space at the moment, there's certainly growing activity around carbon liabilities. And I thought I'd just share what I think is a really interesting case that Marissa and I heard about the other day. This is in Peru, so not directly geographically relevant, but I think still really interesting from the point of view that there was a farmer up in the Andes, in the kind of higher altitudes of Peru, who's operating a farm. The glacial melt has increased in the Andes as a result of climate change, and therefore the spring runoff has increased significantly. And this chap's property was flooded as part of that, and he actually took RWE, which is a big German fossil fuel energy company, to court to seek damages for causing climate change that have basically caused the flooding of his property. Apparently, in the first court case, he was knocked down. He didn't get up, but then he appealed it, and the cause has gotten up for hearing. So I don't think there's that much hope that he'll necessarily be successful in getting damages, but the simple fact that he was able to take an international energy company to court for damages is perhaps a bit telling, and indicates that there are liabilities that may need to be managed by local governments, among others.
And I think the trick there was that now they need to prove that there's some relationship between what the German fossil fuel corporation was doing with, the glacier melting in the Andes. So that's where it gets complicated to make that relationship on how you might be emitting emissions here, causing consequences somewhere else in the world, which up in court might be difficult to sustain. But that's where things are at. So this is going to be an interesting one.
The next one there is around costs. So managing costs. So when you develop a carbon inventory, because of the link between fossil fuel use and climate change, you're actually in some respects you're developing an energy inventory as well. You're working out where your energy consumption is, and that in turn allows you to start to manage some of that energy consumption. And with rising electricity prices and rising gas prices, it allows you to identify potential cost reduction measures. So it allows you essentially to protect yourself against the risk of increasing energy prices. And then there's a kind of reputational and community expectation type risk, where we know that a lot of constituents of local governments are quite progressive on the issue of climate change, and they want to see their local governments manage the issue. And so by developing an inventory and starting to take those first few steps, you can allay some of those risks that may arise in those areas. So then on the flip side of that, we have a range of opportunities that carbon accounting and also and carbon mitigation more generally can bring to your organisation. So the first one is around reputation and community support, which is really just the flip side of that previous one that I mentioned. You can gain support from your local constituents because they see that you're a forward-thinking, proactive organisation in the field of climate change. Savings is really the flip side of costs. So you can identify some really good energy efficiency and potentially renewable energy opportunities by developing a carbon inventory and seeing where the bodies are buried, if you like, in terms of your highest levels of energy consumption. We know that a lot of potential employees these days want to see their employers take climate change seriously. So climate change can be an attraction and retention tool for employers. In the face of things like liabilities and the face of increasing energy prices, carbon accounting allows you to start to develop a forward-looking strategy, a kind of a decision-making framework to help guide your council into the future, so it can be used in that kind of strategic way. And then finally, there's potentially a carbon market advantage that can be gained by councils. So by carbon markets, we're really talking about carbon offsets and the creation of carbon credits and the trading of those credits as a revenue source. And in the context of local governments, we know that there are several local governments around Australia who create Australian carbon credit units, ACCUs, from the destruction of landfill gas, methane from landfills already, and they're trading those essentially as an additional revenue source for council. And there's potential to do that in other areas as well, like renewable energy and also potentially forestry and the land sector within council areas. So the key messages to take away there are firstly that there's a lot of good reasons to develop a carbon inventory, and I'd be really interested to hear from you guys if there's any there that we haven't covered. Please send them through on the chat. But then the other message is when we think about climate change and carbon, we try not to think purely in terms of risk mitigation. We also want to think about opportunities and strengthening your organisation for the future and building that resilience to enable you to be a stronger organisation in the future.
And it will be great to hear from you guys if you have realised any of those opportunities, if you've saved money, if you've seen other benefits from undertaking carbon accounting. You can share that with the others. That would be great for those in the room that are not so motivated yet.
Or not convinced of our description of the risks and opportunities. Yeah.
Help us convince them. So we're gonna get now into a bit more of some basic concepts about carbon accounting. So when we talk about emissions accounting, we are basically talking about accounting for gases that are released to the atmosphere. So we always talk about carbon dioxide, but it's certainly not the only gas in the atmosphere. There's other gases and far more potent than carbon dioxide is in terms of its warming potential. So in that slide, you can see there are 7 gases covered under the Kyoto Protocol. So the first one is carbon dioxide, which is generally emitted from fossil fuel combustion. Then we've got methane, CH4, which is generally sourced from agriculture and landfill gas emissions, and also like the handling of wastewater. Then you've got nitrous oxide, N2O, which is generally sourced from fertilizers. What else do we have there? We have hydrofluorocarbons, perfluorocarbons, and sulfur hexafluoride. That's difficult to pronounce for me.
Yeah.
That's okay. Just excuse my accent there. So those ones are synthetic gases, and they are manufactured for use in industry. So HFCs are generally found in refrigerants. Then you've got PFCs, which are generally used for when you manufacture electronic components, and SF6, which you can find in switchgears as well. And then we've got a 7th gas there, which is nitrogen trifluoride.
Trichloride.
Trichloride, sorry guys. I take feedback very well.
Yeah,
there.
no, you did. It was a good
You did well.
So that's the seventh gas. So this was not originally for the first compliance period of the Kyoto Protocol. There were only those first 6 gases that I mentioned. For the second period, though, that goes from 2013 to 2020, we have a 7th gas, which is NF3. That it's also used in the manufacture of electronic components, so flat screen TVs and new generation solar panels, touch sensitive screens and all those sort of things. So that's now required under international reporting frameworks. It's one of the gases that is required with the other 6. It is not, however, required under the National Greenhouse Energy Reporting Scheme. So that's why it hasn't been covered through this course. It might be included in the future, but it is not at this stage.
Yeah, and I think the point to make there is that often Australia's carbon accounting standards generally have a bit of a lag behind the UNFCCC and the IPCC, which are the international climate change bodies, the guidance that they provide. So I would expect that nitrogen trifluoride would be incorporated in the next iteration of the National Greenhouse Energy Reporting Framework, which will be released in June of next year.
Maybe. Or maybe after 2020 when the Paris Agreement kicks in. We'll have to wait and see. But for now, just so you guys know, you are not required to report NF3 at this point in time. You are welcome to do so if you want to. Then we have as well in that slide those numbers in white, which are the global warming potentials of each of those gases. So those numbers reflect what the warming effect of each of those gases is in the atmosphere relative to carbon dioxide. So carbon dioxide is the most prevalent gas in the atmosphere. That's why we take it as a reference. And that's why the global warming potential of carbon dioxide is 1, and the other global warming potentials are relative to carbon dioxide. So those global warming potentials are determined by the Intergovernmental Panel on Climate Change, IPCC, and they are reviewed from time to time. And they factor in the life expectancy of the gas in the atmosphere and its warming effect in a given time horizon. So we generally talk about a 100-year time horizon because it's understood to be a good time horizon in terms of action on climate change mitigation. So as you can see there, so we've got carbon dioxide, which is the reference with a global warming potential of 1, and then you can see the others. For example, methane has 28. SF6 is, for example, it's not an abundant gas, but its global warming potential is huge relative to carbon dioxide. So it's 23,500. So it means the potential that it has to warm the atmosphere is quite huge. So
we've just had a bit of a tech update. So if any of you are struggling technically, you can try closing and reopening the window within your web browser, and then click on the link again to go back to the broadcast and see if that resolves the issue.
So this is for the person that was struggling and tried a couple of browsers. I think we don't have your name there, but hopefully that's helpful and solves your issue.
I've got a question, Marissa, for you.
And we have a devil's advocate question.
We also have
as
a
well.
devil's advocate question, which we'll come to, which we just broadcast. So thank you for sending through the questions, guys. Keep them coming. So we've got a bunch of gases up on the screen here.
Yep.
And maybe people who aren't familiar with carbon accounting might be looking at that and getting a bit intimidated. But are there, from a local government perspective, which of those gases are we likely to have to deal with most commonly?
Well, most commonly will be carbon dioxide. You will have methane from your landfill, mostly. There won't be that much nitrous oxide, I would say.
No.
Probably not. A bit of HFCs from your refrigerants, air conditioners, and stuff like that. And I wouldn't say that there will be a lot of SF6 either.
I think it's unlikely.
I think it's probably more carbon dioxide, methane, and a bit of nitrous oxide.
Yeah.
It's probably what you want to, focus your attention on.
And then maybe we'll turn to the devil's advocate question
Let's
from Brad.
see.
Thanks, Brad. So the question there, which you should be able to see in your browsers, is could there be an argument made for an organisation to hold off on action to reduce emissions in order to wait for a time when there is a stronger market in offsets, in order to take action later on and access income from higher prices that are available for offsets? So I guess that question seems to be premised on an organisation that was creating carbon offsets. So in a lot of cases, local governments will not be creating carbon offsets. They will be actually buying carbon offsets. So they will want a softer market in order to be able to buy offsets at a lower price. So I think my hot prediction is that I think once the Paris carbon accounting rules get bedded down that we were talking about earlier in terms of carbon markets and carbon credits and that kind of thing, I think we'll see the cost of offsets increase. We're already seeing a lot of markets internationally that the price of offsets increase. So the EU, I saw a graph the other day, EU offsets have gone up from, it was like $5 a tonne not so long ago, a few years ago, to $20 a tonne now. Yeah. In Australia's domestic market, the ERF, we've seen Australian carbon credit units go up from around about $10 a tonne to about $17 or $18 a tonne just in the last 12 or 18 months. So the prices seem to be increasing for carbon offsets. So my advice would be not to wait around. If you're looking to go carbon neutral or to acquire carbon offsets, don't wait around hoping that the market is going to flatten off, because I think it's unlikely to happen. And then also, the sooner you act, a lot of the time, acting on climate mitigation is actually a cost-saving measure. So energy efficiency, and if you're running a landfill, capturing that gas and turning it into electricity, these are all kind of cost-saving or revenue-generating measures. So the sooner you implement them, the sooner you can start saving, the sooner you can start earning money. So I think there's a good argument to be made not to wait around.
And Charlie, I suppose the thing to add is putting together or undertaking carbon accounting for your organisation gives you a bit of a baseline if you haven't done it before, and then doing that internally for your internal reporting, and you can sort of start to identify trends, and then, okay, what's our risk for our council in terms of where our trajectory at the moment. Just being aware about I suppose future scenarios that you need to be planning for, that hopefully carbon accounting will give you the heads up for that.
Yeah, that kind of strategy angle.
Yep.
So hopefully that answers your question, Brad, but please, if it doesn't, please follow up.
Keep advocating, Brad.
I'm going to do the devil's advocate.
Yeah.
So I'm just going to keep with my boring technical things. So basically, we now know that there's a few gases up there in the atmosphere, but when we talk about carbon accounting, we want to talk in a common language. We want to bring everything to a common metric. And that's when we talk about carbon dioxide equivalent, which is basically a measure to compare the emissions from different greenhouse gas emissions using the global warming potential. So as you can see, what we do is trying to bring all those 6 gases we've left NF3 nitrogen trifluoride out of this slide because it's not really at this stage, and then we try and bring all those gases into a common metric, which is carbon dioxide equivalent. And the way to do that is basically you've got the mass of a greenhouse gas, let's say tons. You've got X tons of methane, for instance, and then if you multiply that by methane's global warming potential, that will give you your tons of carbon dioxide equivalents. So we've included in there a couple of examples. This might be pretty basic for some of you that you're aware of this, but for those that are not so aware, just a couple of basic examples. So in the first one, say we release 1 ton of methane to the atmosphere. How do we know how many carbon dioxide equivalent that is? So we basically multiply 1 ton of methane by its global warming potential, which in this case is 28. And that gives us 28 tons of carbon dioxide equivalent, which is the units we use in carbon accounting. The second example is a bit more complex. We get 1 ton of methane, 2 tons of carbon dioxide, and 4 tons of nitrous oxide. So we will multiply those tons by their respective global warming potentials and come up with the final total of carbon dioxide equivalent, which will be 1,090. So that's how it's done. That's how we bring everything to a common metric. And we always talk about carbon dioxide equivalent out there. It doesn't mean it's just carbon dioxide. It means it's all the greenhouse gases that we are accounting for.
And probably obvious, but just to be clear, that TCO2E, the little E at the end, stands for equivalent. And so generally speaking, when we prepare a carbon account, as Marissa said, the units across the board will be in tons of CO2E, as we say. Is this me? This is me. Okay, so now into the really riveting stuff around frameworks and standards. So in order for a carbon inventory to be considered robust, it's got to be prepared in accordance with an agreed and accepted methodology or framework. And these carbon accounting standards, as they're known, typically cover things like how do you set the boundaries, like what boundary are you actually measuring in terms of your emissions, both in terms of the organisational boundary and the operational boundary. How do you actually calculate those emissions? What sorts of emissions factors should you use to inform your calculations of emissions? And also sometimes how should you report those emissions? How should you in some cases trend those emissions over time in order to present a credible account of your greenhouse gas emissions? So I mentioned there, you would have noticed I mentioned emissions factors. So I just wanted to quickly distinguish between emissions standards on the one hand, accounting standards, and emissions factors on the other. So the accounting standards are the kind of high-level frameworks under which we report that tell us what to measure and what the boundary of our organisation looks like, as I just said. On the other hand, emissions factors are basically about calculation of individual lines of emissions. So, for example, in electricity, there is an electricity emissions factor for every state and territory in Australia. So you simply multiply the amount of electricity that you consume by an emissions factor in order to work out what the emissions associated with that electricity consumption are. So the emissions factor is a number by which you multiply activity data in order to calculate emissions, as opposed to a framework, which is a higher level document. So there are several of these higher level credible frameworks and standards that can be used to develop organisational carbon inventories, and in fact many of them are very similar. There are some slight variations. The Learner Guide, which you will all have and which you can access via the Open Learning platform, has a more detailed rundown of each of these standards. And if you want more information, if you Google them, you'll see there's a lot of information available about all of them. But very quickly, just to run through some of the main ones. The most common carbon accounting framework in the world is called the GHG protocol, the Greenhouse Gas Protocol, and it's actually a series, a kind of family of documents, the GHG protocol, and the kind of central document is called the the Corporate Accounting and Reporting Standard. And so that document basically sets out the start to finish of how to do carbon accounting. GHG protocol is freely available. It's developed by credible organisations, the World Business Council on Sustainable Development and the World Resources Institute. It's been kicking around for at least 10 years, probably more now, probably more like 15 years. And it is, if no carbon standard is stated, then typically people will be using the GHG protocol. It's almost at the level where it's the default standard. Having said that, it is not a standard in the formal sense of the word. So the ISO standard, you might be familiar with things like ISO 9001 quality management systems and 14001 environmental management systems. There is an ISO standard for carbon accounting, and it is ISO 14064, and it again provides the information that you need to be able to calculate a carbon inventory, but it actually references the GHG protocol. in a lot of places. So it's actually just pointing back to the GHG protocol as the guiding standard. The main difference being the GHG protocol is freely available, and ISO 1464 costs you about $250. So something to bear in mind as you go through that process. In Australia, we have since 2008 had I've mentioned it a couple of times, the National Greenhouse and Energy Reporting Scheme, or NGER scheme for short. And basically what NGER does is it requires corporations above a certain threshold to report their energy consumption, energy production, and greenhouse gas emissions every financial year to the federal government. And so currently, I think there's around about 2,000 companies within Australia that are covered by that legislation, and each of those companies reports the emissions associated with every single facility under its operational control. So NGER is a really key part of the carbon accounting landscape in Australia. Being Commonwealth legislation, it is freely available, and the way that you measure emissions under NGER is using what's called the NGER measurement determination. So if you look that up, it's a really detailed technical document around emissions calculations themselves. And NGER also provides a bit of guidance around how to set boundaries and those sorts of things. So that's an important one to know about. We have in Australia the National Carbon Offset Standard, which is developed by the Federal Department of Environment, which isn't an accounting framework. Well, it's an accounting framework, but it doesn't. What it does is references other accounting frameworks, so it doesn't have any kind of new material in terms of carbon accounting. It references other frameworks like the GHG protocol and like NGER as the basis on which companies can make certified carbon neutral claims. And the thing about NCOS, as it's named, the National Carbon Offset Standard, is that it also contains guidance around reporting of emissions. So it's not just about accounting, it's also about how do you publicly report those emissions. And then finally, Science-Based Targets Initiative we've put in here. It's not an accounting framework per se, but it is quite a big thing in climate change mitigation at the moment. Basically, it's a set of methodologies. It's not just one methodology. It's at the moment 7 different methodologies that you can choose from to set a target that is aligned to an emissions reduction target that is aligned to the level of decarbonisation that we need to achieve to limit temperature rises to 2 degrees or 1.5 degrees, as we talked about earlier. And it does, again, reference other carbon accounting standards as the basis for coming up with an inventory upon which to base that science-based target. So then, for the purposes, so that's just basically the landscape of carbon accounting frameworks that exist. But what we've done is made a few assumptions in this course around well, we've said what we're going to use as far as carbon accounting frameworks go throughout this course, and we think it's consistent with what local governments are already doing and will continue to do. So we haven't gotten into scopes of emissions yet, scope 1, 2 and 3 emissions. I think we'll probably do that next time around. So I won't delve into that at the moment, but basically the NGER scheme, which I just mentioned, only covers scope 1 and 2 emissions, which, to oversimplify, is basically the direct emissions associated with your activities as an organisation, and also the electricity consumption, the emissions associated with the electricity that you consume. But then there are also these things called scope 3 emissions, which are indirect emissions. They happen downstream and upstream from your organisation that you can be required to account for as well, because they are driven by your organisational activities, even if they don't occur as a direct result of those activities. We'll talk about that in more detail later, but suffice to say, for this course, we're falling back on NGER for scope 1 and 2 emissions. And for scope 3 emissions, we're using the GHG protocol. And specifically, I mentioned that GHG protocol is a family of documents. One of those family of documents is called the Corporate Value Chain Scope 3 Accounting and Reporting Standard. It's a very detailed document about how to report these indirect scope 3 emissions. And we're using that as the basis for carbon accounting for scope 3 emissions. This, by the way, this might be a good time if any of you have other standards that you think we should be considering as part of this course or that you are required to use, then we'd be really interested to hear about them via the chat group. Or even if they're just standards that you've heard of that you'd like a bit of discussion around, then send them through. And then we're also going to use NCOS a little bit. It'll probably become more apparent in some of the later sessions, but basically NCOS has some useful guides around things like materiality thresholds. So if you've got a source of emissions that's really small, NCOS allows you not to have to report that source because it just doesn't make sense to put effort into measuring that. It makes more sense to put your effort into measuring the big ticket items. And so NCOS has some really good guidance around how to set materiality thresholds for emission sources. And as I said before, it also provides good information about reporting of emissions and how that should be done. Oh, and it's also just worth mentioning, NCOS, so there are several local governments within Australia that are NCOS certified. NCOS, the National Carbon Offset Standard, allows organisations to become carbon neutral certified. And there are a lot of local governments in Australia that actually have achieved NCOS certification. City of Melbourne, I know in Victoria has NCOS certification. City of Sydney has it. Brisbane City Council is actually the largest inventory in the whole of Australia that has achieved NCOS certification. So they're a real leader in the space. They have it's about 700,000 tonnes, I think, per year of greenhouse gas emissions that they measure and then offset. And I'm sure there are several regional councils that have achieved NCOS as well that I don't know about.
Do you want to quickly mention the difference between that you can use NCOS to certify yourself, or you can also self-declare?
Yeah, okay. So again, without wanting to get into too much detail, NCOS is a publicly available standard that anyone can pick up and use. So anyone can declare carbon neutrality. It's up to you. You can't make false and misleading claims because the ACCC will get onto you if you say you're carbon neutral when you haven't done anything at all. But there's no trademark on the term carbon neutral. You can go out and do your own thing and measure your emissions and buy some offsets and claim carbon neutrality. But I guess there was a time where that was being done. There are a lot of organisations who are not doing that in a particularly robust way, which is why the federal government went away and developed NCOS. So under NCOS, anyone can access the standard. It's publicly available, and you can actually self-declare under the standard. So you can go through the process and then self-declare carbon neutrality. But in order to be able to use this logo and to be able to claim that you are NCOS certified, you need to then go through a certification process with the Federal Department of Environment, who will, you need to undergo audits, you need to pay a fee to the federal department for the use of the logo. So yeah, NCOS is a little bit of complexity in that. It's not quite as simple as just following a guideline, but several local governments have navigated it effectively. So each of these frameworks that I've mentioned and methods has principles that they refer to or that they're kind of based on. And that they say that reporters should use when they're preparing their inventory. You must adhere to these guiding principles. And the principles do differ slightly across the different standards and frameworks that I've talked about, but they tend to be pretty similar.
Yeah. They are generally the same, but they are defined differently, depending on which standard you're using. But they are always the same, so it's always relevance, completeness, but then they might define it a bit more specifically for whatever the standard you're using. So while you drink water, I can talk through it.
Go for it.
Yeah, so the first one is relevance. So making sure what you are including in your inventory is relevant and fit for purpose. The second one is around completeness. So making sure you are giving a true and accurate picture of your carbon accounts. The third one is around consistency. So it's important that when you develop your carbon inventory, I mean, you can obviously progress it over time, but there needs to be some consistency in the way you apply the different, I guess, steps along the way. And when you, for example, define the boundary of your carbon inventory, it's important that you apply some consistency over time, so it allows comparability year on year. The fourth one is transparency. So you need to make sure if you are using any assumptions, you are documenting those, you're being super clear about what's underpinning your calculations and providing an audit trail. it's also if you are exploring NCOS, for example, you obviously need that audit trail because you're going to have to undergo an audit. So that's important to have. And also when you have like turnover in your organization and maybe, you're picking up someone else's inventory, ideally that person will have documented the decisions that were made at the time. So you can basically leverage and know what was done and apply consistency in the way you do it this time around. And the last one is accuracy. So it's about reducing uncertainties and trying to use the minimum number of assumptions possible. So when there's data, try to get accurate data instead of using estimations or assumptions. So then there's some other principles that are added on top of these 5 under some standards. Some standards talk about conservativeness, for example. So if you're going to apply assumptions, always be conservative in the way you do so. And some others out there, but these 5 are the core principles of any carbon accounting and reporting framework.
So basically, in developing your inventory, this is fundamentally what you should have in the back of your mind as you interpret the standard that you're using, as you apply the emissions factors, and as you report your emissions. These are the principles that we generally you're generally asked to adhere to. Oh, hang on. Oh, hello. We've just refreshed our Q&A here. We've got some
burning questions.
So how does so Carmel from Bayside has a question. How does the ENGA measurement determination link to the GHG protocol?
Well, the ENGA is effectively based on the GHG protocol.
Well, I'm going to qualify that.
There we go.
So in terms of the boundary setting and a lot of the terminology that's used within ENGA, things like operational control and organisational boundaries and that kind of thing, there is consistency between the GHG protocol and ENGA, except that the GHG protocol gives you a choice of different approaches that you can take, whereas ENGA just gives you one. It tells you have to use one approach, which is the operational control approach. In terms of the measurement determination itself, so the ENGA measurement determination is what sets out the emissions calculations, the technical calculations and methodologies for emissions calculations. It doesn't link to the GHG protocol at all in a kind of literal sense. There's no reference within the document to the GHG protocol. It provides a bunch of methodologies for calculating emissions and also emissions factors that are consistent with the GHG protocol. So you could use ENGA to develop a GHG protocol compliant inventory, but there is nothing within ENGA that specifically links to the GHG protocol. That answers the question. You got anything to add to that?
No.
Does it make sense?
There's another comment there from Tony from the Water Corp saying that the 19 Water Corps are required to use ENGA for our reporting to state government, regardless of their size. So that's an example there of important one.
Yeah, an example of. So Tony, if I understand that properly, you don't report to ENGA per se. You're not reporting to the federal government, but you're using the ENGA reporting framework for your greenhouse gas reporting to the state government. Yeah. So that's interesting because it's kind of what we're doing. We're taking the ENGA framework, not to report under ENGA, but for our own purposes to report voluntarily and under different schemes.
But it allows, comparing apples with apples if everyone is using that. Yeah.
And it's a highly robust framework.
Yeah.
Yep. So that one is the next one.
So Zoe has asked, NCOS certified organisation, broadcast that just so people can see it. Are NCOS certified organisations reducing as much as they can and then purchasing residual offsets? I've got to be careful here. So theoretically, under NCOS, to get certification, you're required to have an emissions management plan in place and you're required to reduce your emissions before you then offset. The reality is that there hasn't been a massive focus on the emissions reduction component of that to date, if I'm honest. So theoretically, yes, you are required to reduce emissions. I wouldn't say you're required to absolutely minimise emissions, but you are required to have an emissions management plan in place. But it's not really, we do a lot of NCOS auditing, and when we go in, the emissions management plan is not a focus of the audit, really.
No.
It's what we're required to audit is that a plan exists.
Yeah.
We're not required to audit the quality of that plan or whether it's being implemented. It's just about whether the plan exists or not. But it's a really good point that, you know, certainly in terms of the emissions, the carbon mitigation hierarchy, we want to see emissions reductions take place before offsetting. For the simple reason that if you reduce your emissions, you're reducing the cost associated with those offsets.
Mm.
And there's also a bit of a reputational risk if you jump straight into just offsetting, then stakeholders might look at that and think, well, you're not really taking this seriously, you're taking the easy option out. So there's a bit
And
of
it's also
reputational risk there.
it's also a cost consideration there, because as Charlie was mentioning earlier, like the price of offsets is now relatively low, but it might go up going forward. So those that are relying on offsets, you know, might find that an expensive way of doing things in the future.
So Jackie from Queenscliff has asked which councils are accredited to NCOS. So I mentioned there a few. So that was Sydney, Melbourne and Brisbane. I'm just having a quick look here to see if I can find any more.
Yarra City Council?
Yarra?
We'll look
It's a good
into
question.
that one.
What we can do is, well, we've got the next webinar. We can always take a question on
Take that
notice
Yep.
and include that in the next webinar.
Yep, so Brisbane, Yarra is, City of Yarra is.
Yeah.
City of Sydney, City of Melbourne. That looks to be it for
Yeah.
councils.
For
Oh, hang on,
councils.
Moreland, sorry.
Moreland, yeah, Moreland. Yeah.
Yeah, that looks to be it for councils. But so there is good precedent there. Do we need to answer this question?
No, I need to understand. Oh,
Should you have a look at that and
Yeah,
I'll
yeah,
have a
keep
look at
going.
the, I'll keep going.
Yeah.
Okay, so just, this is actually our last formal slide, you'll be pleased to know. So this was just to draw a distinction. It's kind of actually covered by some of the questions that we've just been responding to. But this was just to draw the distinction between the accounting and reporting frameworks and the emissions factors. So I just want to try to keep those things separate in your mind, remembering that the carbon accounting standard or framework, like the GHG protocol, tells you how to at a very high level, how to do an inventory in terms of setting a boundary, which facilities are in and out, which gases you need to report, which activities you need to report. After you've set your boundary, the next thing you do is go away and actually calculate your emissions, and that's where emissions factors come into play. So an emissions factor is a number that you multiply by some quantity of consumption or some other number in order to yield the emissions that result from that activity. So hopefully that'll become a bit clearer in the next session when we start applying some of these concepts, but just wanted to make the distinction between reporting frameworks on the one hand and emissions factors on the other, because sometimes they're actually incorporated within the same frameworks and sometimes they're quite separate. So one example where they're incorporated within the same framework is NGA. So NGA has detailed guidance on how you set your boundaries, what gases you're required to report, all that kind of thing. It also has the NGA measurement determination, which we just talked about, which has the actual calculation methodologies and the emissions factors themselves. So for the purposes, again, of this course, what we are running with is for scope 1 and 2, we're going to use NGA emissions factors, so specifically the NGA measurement determination, which is, by the way, it's about a 350-page document. Don't get scared. Most of it does not apply to local councils, and we're going to simplify that dramatically for you so that we're really just pulling out the key methodologies that are relevant to councils, which should get it down to a few pages. You don't have to read a 400-page document, that's okay. And then for the Australian government also publishes what are known as the NGA factors, the National Greenhouse Accounts factors, which actually draw in some of the NGA factors. But they also contain these scope 3 indirect emissions factors too, which can be really useful for local governments. So for scope 3, we'll be drawing on the NGA factors as our first port of call. But as a point of clarification, some emissions factors depending on what sources of emissions you have within your organisation, some factors may not be available within NGA or the NGA factors, but we have other sources that we can go to find methodologies and factors for calculating emissions from those sources.
Charlie, I might throw a question or ask you for comment on the verification. So let's say a council or an organisation does their internal carbon accounting. What's your thoughts on getting that verified by someone to make sure that it's accurate, that, you know, it could potentially be published or
Yeah, so look, I think absolutely, if we're thinking about best practice for carbon accounting, I think some sort of verification is essential. It's amazing how even organisations that have been doing this for years and years and years, we do, full disclosure, we are carbon auditors, so I would say that, wouldn't I? But it is amazing how many organisations we go to, even, you know, under the NGA scheme, which is a legislated regulatory scheme for reporting, where we've done organisations over a period of 5 or 10 years, and they're reasonably well sophisticated in terms of their carbon reporting, and we still find some fairly significant errors year on year because, you know, and it's understandable. There's a lot of different moving parts here. We're taking data from a lot of different sources. We're looking at in some cases, you know, there's someone in a council get a stack of electricity invoices and manually transcribe a kilowatt hours number, which is buried amongst, you know, a dozen other numbers on an energy bill into an Excel spreadsheet. There's all sorts of things that can go wrong there. So verification, or it doesn't need to be a full audit. There's different kind of scales that you can do, but even certainly internal quality assurance and kind of peer review is highly recommended. But getting some sort of an independent verification is also highly recommended. And if we look at something like NCOS, the National Carbon Offset Standard, it is a requirement of NCOS that you have a full limited assurance engagement undertaken over your inventory before you can declare carbon neutrality.
And I think that's probably highlights another opportunity through this training or something for councils to think about is if you have someone in your council, a single person that's responsible for accounting, your carbon accounting, what happens if that person leaves or takes another role? You know, where does that corporate knowledge go? You know, by having I suppose a couple of people within a council, you've not only got backup, you've got that opportunity to cross-check, verification, and we know councils are in strong networks and alliances, so I suppose the opportunity to share or you know, not publicise this, but, you know, just to get your peers to sort of check, you know, this is how we approach this, what do you think?
Yeah, absolutely. And I think if that's something that comes out of this course is that there's a bit of a network. I know that there are already greenhouse alliances and that kind of thing, but at the kind of individual officer level, if there's a bit of a network that can form and people can do that kind of peer review, that'd be really valuable.
And that's we are hoping that as part of the face-to-face sessions, people can discuss how they deal with different challenges and so on, because that would all be pretty valuable for them as well.
Sure.
So we have a question, Charlie, for you.
Amanda. Hi, Amanda, from Whitehorse. So the question is, why have you chosen to split your choice of sources of emissions factors? Why not take it all from the NGA factor? It's a good question. And if we were going to simplify things, we probably would say that, as I touched on before, the NGA factors actually draw, so the NGA factors are the source of truth, if you like, for emissions factors and calculation methodologies within Australia. The NGA factors draws from the NGA factors for scope 1 and 2, and then it also adds scope 3 emissions onto that. So the question of why don't we just use the NGA factors if it's drawing from NGA? It's a bit of a technical point, but the NGA factors is a simplification in some ways of the NGA measurement determination. So one example of that is around landfill gas. If you look at the NGA factors, the main kind of methodology there is by applying a fairly blunt emissions factor for tonnes of waste generated, whereas if you go to NGA and look at how you calculate solid waste emissions under NGA, it's a very detailed kind of 5-page process about, you know, inputting weighbridge data and, you know, different proportions of municipal solid waste versus C&I versus C&D waste, and it gets quite technical. So the reason we've structured it like this is to give ourselves the option of leveraging some of those more detailed emissions calculation methodologies from ENGA where we need to, but then also being able to go into the NGA factors for the simplified versions of those and also for those scope 3 factors. If having said that, if you want to go away and look at some emissions factors after this course, don't look at ENGA because it'll scare you. Go to the NGA factors. Amanda's absolutely right. Go to the NGA factors if you want to have a one-stop shop. Go to the NGA factors and have a look at that, and it will bring together 90% of what you need in terms of scope 1, 2, and 3. It's just we've referenced ENGA because there are a couple of bits in there that aren't in the NGA factors that we want to be able to use where appropriate.
That's right.
Is that it? Do we need to address this question, or are we okay?
This is more, so Brad has a question, but it's more from like how do you use, it's about strategic thinking. So I thought we would probably take note of that one and look at it later in the course when people are looking at how do we use all this information
what do we do with
to inform our decision making. And I think it's a very good one, and I've taken notes of that one, Brad. So we'll revisit that one later in the course.
And is it worth just mentioning that, just maybe going back to the structure of the course, or in fact it's the next slide there if you can come to it, where Unit 1 is about the technical carbon accounting, developing an inventory side of things, and then Unit 2 is about what do you do with the inventory once you've got it. So that sounds like it's maybe more of a Unit 2 question.
That's what I was thinking. So we'll take note of that one.
Great. So at the beginning of the presentation, the webinar, we put a couple of questions to you guys, and some of those we've maybe addressed a bit on the way through, but we were just keen really for you guys to throw anything at us. We've got another 10 minutes theoretically. We don't have to use all that time, but if you have any questions, if you wanted to provide responses to the questions that you can see on the slide here, we'd be really interested to hear about that, to get a bit more of a sense of where people are at with their carbon accounting journeys. So please chat away. We have a couple of other points there. Do you want to?
No, that's a question from Tony from East Gippsland Water, noting that the current national greenhouse accounts factors, ANENGA, the global warming potentials, including those documents, are different to the ones that we presented in our slide earlier, and that's because both the NGA and ENGA still have the global warming potentials from the 4th assessment report released by the IPCC, which was the 2007 version.
The IPCC being the Intergovernmental Panel on Climate Change, the UN body with responsibility.
Which is the body that sets those global warming potentials and revise them every few years. So the NGA and ENGA still have the previous version of those global warming potential. Then in 2014, I think it was, the IPCC released the 5th assessment report with new and updated global warming potential values, which are the ones that we have presented in that slide. But we are aware that both the NGA and ENGA still have the 4th report values. So you are perfectly okay to use the 4th report values. So whatever ENGA and NGA is telling you, we are just giving you the most up-to-date global warming potential values available to you. And international frameworks like the GHG Protocol will recommend that you use the most recent global warming potential. But of course, if you are referring back to NGA or ENGA, then you will see that they still have the previous values, and that's totally fine for you to use those as well.
Okay.
And just to, I guess, explore the underpinnings of that point. So the 4th assessment report had a methane global warming potential of 25 times. So 1 unit of methane is 25 times as potent as 1 unit of carbon dioxide. And then the latest version, that goes up to 28 times. So this is basically in response to science, to the evolving field of science. And it's complex because those global warming potentials, it's not as simple as just saying, one is more potent than the other at a kind of chemical level, because there's also a time element to this. So different gases remain in the atmosphere for longer and therefore their global warming potential, it may be milder in terms of their straight up the potency of the gas, but if they linger in the atmosphere for a lot longer, then over time the cumulative impact of those gases can be higher. Yeah. So what the global warming potentials do is they try to consolidate those potentials over a 100-year period. So methane went from 25 to 28. Nitrous oxide, on the other hand, went from 298 down to 265. So you've got methane going up a bit and nitrous going down a bit. So it's a bit of a movable feast, and I guess, you know, the positive takeaway there is that scientists continue to learn more, and the science evolves, and over time we get more and more accurate.
So you're saying they either using the data from the 4th or the 5th is still okay? I suppose it's just about referencing, you know, what your
it's a tricky one in the sense that, you know, on the one hand, we want to be simple and say use NGA.
Yep.
On the other hand, we want to say use the latest science.
Yeah.
And when those two things don't agree, then it's a bit of a.
I guess there's no right or wrong at this stage, because obviously the national documents are telling you use the 4th report. So that's fine. And I think to Luke's point it's all about documenting and making sure you're aware of the decision being made at that time.
And making the assumption clear.
And if you are referring back to NGA, and at that point in time, those were the global warming potentials that NGA included, then you are fine. If you want to be a bit more, up to date with science, then go for the 5th report.
And we should caveat that by saying that the NGA factors and NGA will get updated. At some point, they will get updated. I expect it would happen next year. Those two documents get reviewed annually. It's in kind of May, June that they get reviewed. So I expect that they would get updated, but it may not happen for a year or two.
And I think Tony's making a good point as well. It just takes time from when the IPCC updates the global warming potentials until when Australia takes on those ones and updates its documents. So it's a bit of time difference in that point. So we've got
a question here from Carol from Strathbogie. Saying that we'll broadcast that now, a few councils in the regions have started to register their own land as native vegetation projects, carbon offset projects for council, rather than purchasing on the open market, which she's saying is more cost effective and better for local biodiversity. So that's really interesting. I haven't seen a council, we've spoken to some councils about this actually, and there's certainly a really strong desire from councils to have projects within their LGAs, because, you know, it's a great story, it's local, it potentially creates employment opportunities, and also it potentially gives them access to carbon markets as a kind of external revenue stream. So that's great that councils are actually driving that forward. There are some difficulties involved in doing that in terms of getting projects off the ground, but great that councils are looking at that, and certainly Carol's absolutely right in that there are great biodiversity benefits from doing that too. So yeah, if you're thinking about carbon offsetting, absolutely the first thing you should do is think about opportunities within your own LGA, whether that's land sector projects, as Carol was talking about, but also potentially renewable energy projects and energy efficiency projects. You can create carbon credits from all of those different types of projects.
So that's the question from Rod. So is there an expectation that carbon inventories will become mandatory for LGAs? And if so, when? That's a tricky one.
Look, I don't know if you've heard anything on this.
No.
Just don't know.
It's hypothetical. Yeah, I don't think there's been, not aware of any push for that. I think it's probably what I'm observing in the local government sector. It's good practice. It's just actually good practice for councils now to be off. You know, in the past they might have outsourced this to a third-party provider, but now it's looking about building that internal capability, and more councils getting on board with actually getting across what their own footprint is, and for their, you know, risk mitigation and future planning. So, but Rod, I've heard nothing. You know, hasn't been raised at all.
Maybe.
I would say if we use water corporations as an example, they are now required to. We talked before about how they made pledges out to 2025, and as part of that, they had to use the ENGA methodologies to calculate their carbon inventories. It wouldn't surprise me if something similar came into play, particularly given the Victoria's net zero emissions target and the state governments need to track against that target and the role that local governments play. We may see something emerge, but nothing on the table at the moment.
I think we have a question from Amanda as well, from Whitehorse City Council, that reads, if emissions factors and global warming potentials change over time, does that mean that we need to update our historical calculations? And the answer to that, don't contradict me, is no. No, when you calculate your emissions inventory, you use the factors that you have at that point in time. And you do have to look at which factors are applicable to that year, but you don't have to go back and back calculate all your historical emissions based on the new factors. And generally, what we see, for example, when we go to a client and obviously some of the emissions factors have changed, and as a result, the emissions profile has increased, then there's always a commentary around that is due to the emission factor going up and so on, but there's no need to go back and calculate again all your historical emissions now. There's no expectation for you to do that.
We've got couple of questions coming in thick and fast here, and I'm very conscious of time, so we're going to try and get through these really quickly. Firstly, Zoe just had a clarification for Carol in relation to those land sector native forest offset creation within the LGA, saying, is that not double dipping? Zoe's understanding is that if the project is for biodiversity loss, we cannot use that as an offset. So Zoe, I would just say under the Emissions Reduction Fund, which is the Australian scheme for creating carbon credits, you could, biodiversity loss would not constitute an additionality issue in terms of a land sector project. So you could do it as part of a project that was about improving biodiversity, and in fact, that's why the methodologies were developed, is because they have that co-benefit, that biodiversity co-benefit. And Carol's clarified that by saying no, there will be a net gain on the land. I just want to get to this other question about PPAs. So there's a question from Carmel at Bayside about, will there be an opportunity to cover how councils can use renewable energy PPAs? Look, we can. So renewable energy PPAs is basically buying, entering into a long-term electricity supply contract directly with a renewable energy project. And it is a really common technique at the moment for managing emissions, because you can basically neutralise your Scope 2 emissions if you purchase 100% renewable energy direct from a project, so you can get rid of those Scope 2 electricity emissions. We will probably touch on them as part of, I would think, Unit 2.
Yeah.
We won't go into great detail, but what I would say there is that there's a lot of work being done. We're doing an engagement with the Central Victorian Greenhouse Alliance at the moment. I know that SECA is looking at this, and also EGA are looking at PPAs at the moment as a really hot topic, and so there's work being done there. And then of course Melbourne City Council did the MREP project, and they've published some really good guidance on PPAs, what they are, how to enter into them, those kinds of things.
Awesome. So just super quick, because we are a bit out of time already. Thank you for all your questions and for getting on the conversation with us. Just the last slide that we have is around what's coming next. So on Friday at 10 a.m. we have the second webinar, which is around accounting boundaries. So that's 10 a.m. Again for 1 hour and a half. So we'll wait for you there. But in the meantime, the online module within Open Learning is available for you to get in there, have a look, read through, complete the quiz. If you can do that before Friday, that would be great.
So can I just clarify that we're looking for people to complete the quiz for Module 1 or Module 2?
Module 1 and 2.
And 2.
Yeah, both. Ideally, just because that way you've run through the theory, as we said at the beginning, and then you come to the webinar ready to ask questions and discuss more than being a masterclass as such. So that's what's coming up. And I think that's it from us. We have another question there.
Oh,
No, that's
no.
just a clarification from Carol. So.
That's good. Yeah, I mean,
Final.
thank you, Charlie Marissa. Great to see the questions coming through.
Yeah,
Actually,
yeah, it
it's
was.
sort of
Keep it up, team.
keep it up. We welcome any feedback about how the technology is. This is the first one, so there were a few little sort of things from you remote users. You know, we've had run now, so the refresh screen and that type of thing. Yeah, I did carbon accounting a couple of years ago at Swinburne Uni when they were running this. So this was a really good refresher and got me back into all those different frameworks. And
Little things.
yeah, really good. But thank you. We'll finish up now and we'll talk again on Friday.
All right. We'll see you all then.
Thank you all very much.
Thank you.
Bye now.
Bye.